Good afternoon and welcome this afternoon to Market Movers. I almost said Trader Talks, and that was this morning as it kicked off this last day of the trading week. Now we are wrapping up the last day of the trading week. I just heard the closing bells. That means the market is done, and I am here with you. Welcome to all of you who are joining us today. My good friend Brent Moore is out there in the chat. He's a 20-plus year veteran of the financial markets, and he fills in this webcast for me on a regular basis when I'm out on the road teaching. But again, my name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. For all of you who are joining us for the first time, welcome to all of you. Maybe a little bit better way to wrap up the week this week than it was last week, as we see some upward movement and take a look at where things are. But before we get into that, let's do a couple of quick things. Let's take care of a couple of quick housekeeping items. Remember that everything we talk about is simply for illustrative and educational purposes only, not a recommendation or advice. If we happen to talk about options, which we probably won't in this discussion, remember that options carry a high level of risk. They're not suitable for all investors. Make sure that you weigh the characteristics and risks. Standardize options before considering any option strategy. Also, we're going to be using the Thinkorswim desktop software platform, specifically the paper money version. It is not a guarantee of future success out there in the real world, but it's a good playground to learn about the market. Also, we're going to talk a bit about technical analysis and other things, other ways to look at the market. They are not guarantees. They're all theoretical in nature. Schwab doesn't recommend the use of technical analysis as a sole means of investment research. Past performance, no guarantee of future results. So let's get into this discussion. We're going to talk a little bit about what the trend has been over the course of the last week, some of the things that have moved the markets, and maybe some of the ways that portfolios were impacted. And as I'm doing that, I'm going to jump back over here to the Thinkorswim desktop software platform. And I want to bring up, first of all, we'll come back to that particular view, but I want to come back over here to the index view and see what's going on in the major market indexes. While we're doing that, good opportunity for me to remind you to click on subscribe and like. If you haven't done that before, please do that. It's going to help you. It's going to help us. It's going to help other people bring the content up to the top of the algorithm. So thank you for helping us out with that. Also, click on like if you wanted to, if you want to give us some support there as well. You can also follow me on X at Ben Watson CS. You can follow Brent on X at Brent Moores CS. And John P says, not what I expected today. But let's take a look at what is going on and see how that falls in the expectation of what's been going on here in the course of the last couple of weeks, right? So taking a look over here on the right-hand side of the SPX, here's where we were in February. About this time in February, we saw the move to the downside. Here's where we are just about a month later. I'm sorry, just about, where are we? So about 3 months later. So it's taken it 3 months to go down and then back up. And we're almost back up to those same levels, right? We're almost back up to those highs. That shock that we saw as a result of tariff talks and everything else, moving the markets to the downside. We saw this kind of very peaked, discrete, exquisite bottom here, and then that rally back up, almost a pure V bottom, but not quite. And we see this rally up off the right-hand side. A couple of things have happened over the course of the last week since we talked about this last. And a couple of those are very significant. One is the break of the 200-period simple moving average on the S&P 500. Two is kind of a coincident indicator here, and that is the break of this horizontal level at about the 5750, 57,600 or 60 level, somewhere in that range, about where I've got my cursor. That horizontal corresponding with the 200-period moving average would suggest kind of that technical toggle point, right? That switch back to the upside. And in fact, over some of the webcasts that we've taught this week, that has been a topic of conversation, right? The technical switch back from the bearish expectation to the bullish expectation. Now, does that mean the market's going to continue to run bullishly and we're going to continue to see new all-time highs like we were seeing 6 months ago, 9 months ago? I don't know. I don't know that we're there yet, but is it also suggestive of the idea that maybe we see a turnaround or we see this reverse and go back down? The behavioral nature of investors in general is that we tend to anchor to recent events. So the mental anchor, it's mental anger too, but the mental anchor that a lot of investors have at the moment is this anchor to this big downtrend, right? This is kind of what's stuck in everybody's mind and thinking that's going to happen again. Now, could it? Yeah, it could. There's nothing that says that it can't, right? There's nothing concrete underneath levels of support. I mean, they're not hard and fast rules. They're not guarantees by any means. Markets can move down through those levels, and all it takes is news. All it takes is kind of a shift or maybe even an increase in panic or increase in fear, whatever, right? Here we are back up at some of these previous levels. And let me kind of clear these annotations for just a second. Here we are back up at some of these previous levels, and we're tapping those levels again. And we're now doing this from a position of some pretty good strength. Whereas coming into kind of this time frame right here, there was already kind of a crack in the armor a little bit, right? The RSI was diverging a bit bearishly, and we're starting to see that downward movement. Scott says, yeah, absolutely. Losing sucks, and it leaves a lasting mark while the joy of winning seems to fade faster. Absolutely, right? We ascribe more impact physiologically, psychologically, behaviorally to a losing trade than we do to a winning trade, right? Winning, we simply say, okay, cool. Losing trades, we're just bummed out about it for a long time. And still, I think this market is a bit bummed out about it. I think I described this bull market over the past few weeks as kind of a reluctant bull market. And I think that kind of represents this scenario here. Now, what I'm not reluctant about, though, however, is to point out the fact that we've got a feedback survey in the chat there. Help us out. Fill out that feedback survey. Brent's going to put that up at the top of the page so that you can come back up to it and you can find it again. But it's right there. Help us out. It's a couple of quick questions. It's going to be a nice way to end the week and give us a hand in helping to make these sessions better. So we can see what happened over the course of the week. We were up on the week 5.27%, on the month, kind of halfway through the month here at this particular point. We're up about 7%. Year to date, again, here's that idea, right? Year to date, we are just simply slightly positive here in this particular case. Yeah, Brent, you're absolutely right. Prospect theory is the entire perspective from a behavioral finance standpoint that describes that scenario where we get more value psychologically out of more impact psychologically out of a losing trade than out of a winning trade. But the market's still moving higher. The RSI kind of knocking on the door from underneath on this overbought line. So suggesting that it's not yet up in that overbought. It's not yet at an extreme. Yes, Kahneman, exactly, Scott, for sure. That we're not yet overcooked. Take a look at the NASDAQ. We're up in that overbought range. Still doesn't mean that this is overbought to the point where it has to turn around. But we're at a higher level. I mean, there's more separation here between the 50-period moving average. There's more separation here between the 200-period moving average on the NASDAQ. We're back up in some of these resistance areas here, not yet back up to these previous highs. So some strong momentum. Now, that may suggest, given the fact that this is the first time really since that November-December timeframe, that the NDX, that the S&P has kind of notched up in that overbought range, that there may be a bit of a pullback, right? There may be that perspective of a little bit of a pullback. Now, does that mean we're going to see a reversal all the way back down? Well, that's what everybody's afraid of, right? Is that it just, boom, the rug gets pulled, we're left holding the bag up here, and everything collapses underneath. But nevertheless, you can look at where these levels are on these indexes. You've got a support level here. You've got a support level down here. You've got a support level here at the edge of the gap. You've got a support level at the 200-period moving average. You've got a support level below that. You've got a support level down here at the 50, right? So there are lots of levels of support. And unless it's something that is apocalyptic in nature, these areas are likely to still act as those levels of support. And also the push to the downside, even if it's the same news, right? Even if the news comes back and says, hey, tariffs are coming back, we're rescinding the pause, things have broken down, talks with all of these countries have broken down. Even if that were to happen once again, because that was kind of the catalyst here in this scenario in pushing the market down, it's very likely that this, if we do get another leg down, that it's not going to be as bad as it was the first time. And that's the nature of fear, right? So let's take a look at the Russell 2000 here. We can see that even in the Russell 2000, making that gap up, a little bit of a pullback, kind of that bull flag perspective, a little bit of a breakout on a horizontal resistance level, not yet reclaiming the 200 period moving average, but gaining some strength, not up into the overbought range yet, but still moving higher, still gaining some strength at this point. But what I wanted to do now is I want to pop back over here to the VIX, because this helps us to kind of explain the nature of fear. And we've talked about this before, talked about the idea that, you go to I personally, and I'm just going to say this is not a recommendation or anything else. I don't like horror movies. I don't like that genre. I don't like going to see them. I scared myself to death when I was a kid going to see some stupid horror movies, and I don't like them. So I don't go to see them, but I'm projecting this as a metaphor, right? That you go see a horror movie, the first time you see it, you get really scared and you jump. And then you go see it again. I don't know why anybody would do that, but you go see it again and you jump again when you see it, but you don't jump quite as much because you've seen it before, right? And then you go the third time and you go, okay, well, that's cool. Oh, look, by the way, there's a microphone in the scene, right? That kind of stuff. And I think, Wiley, it was Amityville Horror probably that did it to me. That was the one that got me. But that's the nature of fear when it comes to the market, right? We see that fear the first time and it's a visceral reaction. We see it second time, it's not as much. We see it a third time, still not as much. And then it bleeds off and we're left with kind of this stasis, right? The what do we do? Yeah, Texas Chainsaw was another one. I like this, the way, so if some of you have seen George Tillis on the Schwab Network, by the way, Schwab Network brought to us by our media affiliate, Charles Schwab Media Productions, separately affiliated company. George has a great way of describing this, and he in fact described this in the newsletter that the network publishes as well. He says investors are operating now under a ceasefire mentality, right? They don't think the war is over, but at least nobody's shooting at them at the moment. And I think that's reflective of what's going on here, right? They've been buying, they've been pushing prices up. The VIX has come back down to the 17 handle and it's kind of sitting here. And it's sitting at this level that suggests that not a lot of hedging activity is going on in the market, right? Not a lot of investors buying, not a lot of institutional investors buying hedging products. But then you look at the comparison here, and these two lines, the white line here in this particular case is what's called the VVIX, the volatility of the VIX. I just need to move my labels around a little bit. And the blue line is the VIX, what we were just looking at in the candlestick chart, right? And yeah, you're right. It was a remake of the Amityville Horror Show. Yeah. But you notice what's happened. So volatility of the VIX, the VVIX, suggests that investors are a little bit more fearful. When you see the VVIX below the VIX, that suggests that there's not a lot of buying of those products, right? There's not a lot of buying of those of institutional hedging products. And from that standpoint, what that means is the market's not very fearful. Now, there's a little bit of a switch here. So we've talked about it before. We talked about it last week. I've talked about it in my webcast a number of times about the idea of being, of buying umbrellas when it's not raining, buying umbrellas when it's cheap. And I think this is reflective of that. When the VIX is low, there has been a little bit of scooping up of institutional hedging products. And I think that's what's reflected here. Now, does that mean that the market is going to move lower? No, it doesn't. But let's combine these two scenarios, right? You've got a little bit of hedging going on. We can see that coming from the fact that the VVIX is above the VIX. That suggests that there's a little bit of hedging activity going on. And we go back to the previous index that we were looking at, right? Our index grid. And we look at the SPX and we see it's up against a resistance level. The RSI is up against that overbought range. Could we see a little bit of a pullback? And I think, yes, that is a possibility going into next week. Now, going into next week, because we're going into Memorial Day weekend, here's the other reason why that might be the case. Going into Memorial Day weekend, it is in and of itself next week not a holiday shortened weekend. But I'll tell you what, it's a pretty good bet that you've got institutional traders, you've got retail traders that are going to start peeling off midweek, and you're going to start to see volumes diminish going into next Friday. And so when you have a lower volume market, markets can get pushed by smaller impacts. So we might be having a totally different conversation next Friday than what we're having today in this conversation. So something to pay attention to. It not be fearful of, right? Going back to our discussion, and a phenomenal discussion here in the chat about fear. So keep that in mind just as we look over the horizon here, that there is that potential. Now, I want to do this to kind of set up what's going on for the day and then, or for the week, and then to kind of talk through these ideas into some specifics. Let's look at the news for what happened this week. So we can come down here. I'm on Schwab.com. I'm at this is the easy way to find it. Schwab.com, Research tab, Research Tools, U.S. Markets, and then I've selected the calendar. And I'm looking at economic events that happened this last week. We saw a Treasury budget. We saw CPI numbers coming in a little bit lighter. That suggests that inflationary pressures are easing just a little bit, theoretically. Wait till we get the revisions. Crude oil inventories were building a little bit. Despite that, crude oil still moving up for other geopolitical reasons, right? And other demand potential reasons. You see business inventories down a little bit. That would suggest maybe a little bit more utilization. We see capacity utilization kind of staying about the same, maybe down a little bit. Continuing claims were up just barely, probably just about staying the same. CPI down. Again, inflationary pressures weakening. We see things like initial jobless claims staying the same as they were the previous. So no change in the labor perspective. PPI down. Again, inflationary pressures diminishing a little bit. Retail sales down a little bit, but remember, revisions are going to matter here because a lot of these retail sales numbers are reflective of that pull through prior to tariffs. Now we get to today, and we get things like housing starts. And housing starts were, in fact, up a little bit. And that is suggestive, again, of maybe some more upward risk-on pressure in terms of the market. Building permits down just a little bit, but housing starts, that's usually a key indicator. Consumer sentiment, on the other hand, still slipping. We look at the prior number, 52, still expansionary, but not, it's just been hanging on by a thread here in terms of expansionary. So when we look at this next week, this could be different. Let's come over here to next week's information and see what is on the docket for next week, right? So Monday is going to be typically a quiet. We get leading indicators, but they don't necessarily lead very much. Tuesday is going to be pretty quiet. Oil inventories are expecting to build. We've got continuing claims. We've got existing home sales that'll come out next week. Now we get to manufacturing and services PMI. Now these are the primary numbers, the prelim numbers. Those are going to be revised. But again, if we start to see that these are now moving more expansionary and less contractionary, if these are still above that 50 level, that would suggest, again, more growth in the economy. And then we're going to see new home sales. But what we're going to get over the course of the next week is if we shift this view to earnings, coming up next week, we're going to have in that next week timeframe, we're going to have some of the retail names. You're going to have some of the home retailers, home improvement retailers like Home Depot. You're going to have Toll Brothers in the housing space. You're going to have, let's see, what do we have coming up on Wednesday? TJ Maxx, Lowe's, Target, Baidu. You're going to have VF. All of these are going to be retail sales. These are late cycle earnings announcements. And that could give us a read on kind of that consumer sentiment perspective, right? And Siri says PMI above 50 will impact positively to industrials. Generally, that's going to be an indication that we're going to see that possibility of that move to the upside, right? Okay. So John asked, where is this? This is in the research section on Schwab.com. And then went to U.S. markets. So if I go to research, U.S. markets right here. And then I'm going to scroll down over on the right-hand side to calendar. And that's where I'm getting to today's events and earnings. So let's do this. Let's come back over to the platform real quick, the Thinkorswim platform. There's two things I want to look at. One, I want to look at kind of what's going on a sector basis. So the first thing, as we kind of wrap into the end of this discussion, is how is the market doing relative to its moving averages? So we talked about this last week. Greater percentage above the 50 period simple moving average, greater percentage above the 100 period simple moving average, greater percentage above the 200 period moving average. As long as these lines are still going up, the market breadth is increasing, right? The market breadth is growing, and that's going to continue to drive. If we start to see this shift again a little bit, if we see a move, and it's going to happen first with the faster moving average, 50 period simple moving average, you're going to see that turn. These are the index symbols that you can use for that. $SPX A50R, A100R, A200R. Brent talked about this in a webcast earlier this week and in one of his short videos out there on X. He talked about this as well. You can find that information about how to use these tools. Okay, so now that we know that the market breadth is pretty decent and increasing, let's come over here to the Market Watch tab. Actually, before we go to the Market Watch tab, I want to do this. I want to come back here to our sector index grid. All of these grid links, by the way, are in the description page for this webcast, so you can access those. Yeah, so Siri asked a great question. We're going to get right down to that. So let's take a look at this. So these are the sector indexes, right? So we've got, and I've just got these kind of, I need to shrink these labels to make them look a little bit better, but you can see what they are. Energy is still moving down, maybe turning sideways. Materials, which is largely energy driven, moving down, kind of turning sideways. Industrial starting to hook up there. And again, that's going to be airlines, that's going to be Boeing, that's going to be the manufacturing companies, that's going to be the Snap-ons of the world, those types of companies, right? So we'll get into industrials here in just a second, Siri. Discretionary spending turning up. And again, that may turn up a little bit more as we start to see some of those retailers reporting. But staples moving down. There seems to be a flow away from defensives and to discretionary. Healthcare continuing to move down, though we've seen some move in the pharmaceutical space, but a lot of it's been to the downside. Financials turning back up again a little bit as interest rates have been changing. But information tech, one of those interesting areas where you see that little bit of a flip back to the upside, some strong movement as some of those tech leaders come back into play. Same thing with communication services. Utilities kind of staying neutral, and real estate still staying in somewhat of that downward trajectory. So I think industrials is pretty interesting here. Let's click on industrials. Let's maximize this group, and you can see the strength that's being displayed in industrials. In fact, it's moving above that previous high. It's well above, in this case, the 50-period moving average, and it's been run to the upside here in industrials. That doesn't mean that it couldn't turn around, that these industrials couldn't turn around. So what I'm going to do is I'm going to go to the Market Watch tab, and we're going to take a look at the S&P 500 really quickly to kind of wrap this down, and let's kind of take a look at where some of those leaders have been. Remember, this view on the Market Watch tab is a snapshot view. This isn't historical. This is simply today. This is what happened today. Where was some of that strength? And we look in the information technology space, and it wasn't in the big tech leaders. It wasn't in NVIDIA. It wasn't in Microsoft, although they were positive. It was the smaller names like Adobe and Micron and AMD. So some of the chips were moving a little bit higher here. Dell moving higher. HPQ, Supermicro gaining some strength. Communication services, Disney still up. Netflix, the Googles moving higher. Fiserv in the financial space. Visa in the financial space. You come over here to consumer discretionary. Amazon kind of bridges this gap between technology and consumer discretionary because of Amazon Web Services, but you get some strength in Tesla and in bookings and in McDonald's. We talked a little bit about McDonald's in a couple of our webcasts earlier this week. Consumer staples, Walmart up, Costco up, Colgate-Palmolive up, some of those more defensive staples, United Health up, Lilly back up with their change in leadership. Not seeing a lot of strength in energy, not seeing a lot of strength in materials, not seeing a lot of strength in utilities. But let's click down to this industrial space. And so I'm going to come down here to industrials, and we'll take a look at where those sectors were that saw some real strength. It wasn't necessarily in aerospace and defense. I think the real strength here came in machinery. Caterpillar has been rocking and rolling. Deere's been running like a deer. Sorry. The lighter the color, the more intense green, the bigger the percentage move, Vic. The more intense the red, the bigger the percentage decline. So that's kind of the space. And the larger the box, the bigger the market cap. Uber up, Pentair up, Nordson up, but also seeing some strength in the multinationals, 3M, and others. So you can kind of drill down into the space if you wanted to get a little bit more granular. You can break this down. Here's aerospace, and we can see where the strength was there. Let's see, construction equipment or commercial machinery. There's machinery. Deere, the big winner in this particular case, in that move to the upside. Otis has been up and down. That's an elevator joke for you folks. I say Otis has been up and down. They make elevators. Never mind. Some of you got it. Hey, what a great way to finish the week, though, seeing a lot of green on these charts and these heat maps. Certainly a better perspective, I think, from a risk scenario than what we were seeing last week as we kind of wrap into this and come back down. But yeah, exactly, James, for sure. But as we come back down here to the indexes and we take a look at what's going on, again, this is an area where it it pays to be mindful. So watch this 200 period moving average, watch for a pullback against these resistance levels in these major indices. and keep your eye on the volatility and see if volatility starts to tick back up and if that's an indication of more hedging activity. Guys, if you want to learn more about this stuff, come on over here to the Trader Talks webcast page. If you haven't done so already, click on subscribe. You can find all of our archives right here. If you come over here to schwab.com/coaching, then you get the whole calendar of our upcoming webcasts. You also get the calendar of our in-person events. If you're going to be around the West Coast, the end of the month, I'm going to be in Anaheim, California, steps from, in the shadow of Disneyland, talking about advanced options over 2 days with my good friend Kevin Hinks. Hope that you have an opportunity to join me for one of these events. We're going to be in Miami. So we're changing coasts. We're going to go there in a couple of weeks as well. And as always, guys, as I sign off this week, my thanks to Brent and for his help all the time and for the great content that he provides and all the other coaches here at Schwab Coaching, all of our great production staff and our reviewers and everything else. The Anaheim event is going to be at the Anaheim Marriott, which is just down the road. But I'm just going to say this, guys, as you go into this weekend and ahead of kind of a big week next week, a big holiday week next week, and as you're starting to take a look at what's going on, keep your arms and hands inside the ride at all times. Hang on and have fun. We'll see you soon next week. Bye-bye.